DeFi lending has received a lot of attention lately, but there are several concerns that you should be aware of. Stay tuned as we'll be unveiling everything to know about the 3 major DeFi lending risks that you should know. As new DeFi protocols draw interest from investors across the globe, the phrase DeFi has become rather ubiquitous in the cryptocurrency environment. The trend of decentralized finance accelerated in the years 2020 and 2021, which was a very promising year for the industry. DeFi recorded an incredible 335% year-over-year gain in September 2021, following a 35% decline that followed an impressive growth streak between January and May. The extent of DeFi lending and borrowing has drawn the most attention because so many financial services are being altered by DeFi. Investors are therefore concerned about the risks associated with DeFi lending, and how those risks might ultimately damage DeFi. You can get a thorough understanding of the many dangers connected to DeFi lending and borrowing options by staying till the end of the video. In terms of capitalization as of June 2021, DeFi lending and borrowing procedures has a nearly 18% portion of the whole DeFi market. Therefore, it is clear how DeFi financing is promoting awareness of the idea of decentralized finance. DeFi lending now attracts attention for its risks due to its unbelievable return rates. DeFi provides an ecosystem of financial services that are comparable to those offered by traditional banks, financial intermediaries, and insurance brokers. Here's the twist. You do not need the assistance of brokers, intermediaries, or other third parties to access financial services like loans. DeFi makes use of decentralized applications or dApps, which operate autonomously on the basis of smart contracts. Smart contracts are specialized computer programs that carry out particular tasks when certain predetermined circumstances are met. As a result, it is easy to see the potential for remarkable future growth of DeFi lending. Because DeFi lending is a notable DeFi service, the focus on what are the risks of DeFi lending is obviously valid. Crypto lending has been transformed by decentralized apps since they have made it more accessible to a wider user base. DeFi financing now allows cryptocurrency investors to lock up their money in a manner similar to a savings account. Investors could potentially leverage their cryptocurrency holdings to provide liquidity on a variety of DeFi platforms. Investors would earn prizes and consistent payments in exchange for locking their money on the platform. Additionally, the rates on new DeFi lending platforms are sometimes far higher than those in traditional finance. DeFi lending is undoubtedly a trustworthy way for cryptocurrency owners to generate passive income. But before you get started with DeFi loans, it's also crucial to be aware of the main risks. 3 significant dangers that are connected to DeFi loans and have a significant impact on the DeFi ecosystem may be found. Flash loan attacks, DeFi rug pull tactics, and impermanent loss are the 3 main hazards associated with DeFi lending. Let us shed more light on the risks you must consider before participating in DeFi lending. Number 3. Impermanent loss. For obvious reasons, what are the risks of lending on DeFi is a question that is frequently answered with the phrase impermanent loss. The biggest cause of impermanent loss is the volatile nature of crypto coins. For DeFi lending, investors must lock their assets in liquidity pools, and the assets' price fluctuations after being deposited in the pool result in a temporary loss. For an in-depth understanding of DeFi risks such as impermanent loss, you need to understand the principles of liquidity pools in DeFi. The automated market maker technology, which is employed in well-known DeFi liquidity pools, has a significant impact on the risk of temporary loss. The DeFi pools are required to maintain a specified ratio of assets to tokens in the pool. For instance, by setting the pool's ratio at 1:50, a liquidity pool might contain both ETH and LINK tokens. As a result, everyone who wants to contribute liquidity to the pool should contribute both ETH and LINK in the same proportion. The risks of impermanent loss associated with DeFi lending also result from the fact that DeFi pools heavily rely on arbitrage traders to set the values of the tokens in the pool, in line with the current market value. When the value of the tokens in the pool changes, they might add new tokens with a higher value. Therefore, arbitrage traders would add ETH to the pool in exchange for removing LINK if the value of LINK decreased. When arbitrage traders substitute just one more token for the discounted token, the ratio of the coin does, however, alter. This means that the liquidity pool would automatically raise the price of the token with a high supply, LINK, while lowering the price of ETH. In turn, it might tempt arbitrageurs to rebalance the pool. As soon as the pool has been rebalanced, you would be exposed to DeFi risks of impermanent loss. In most cases, the value of the assets in the lending protocol is more than the increased value of the liquidity pool. You would get a quantitative perception of temporary loss from the discrepancy. You may have noticed that one of the main hazards associated with DeFi financing is a temporary loss. But you shouldn't let impermanent loss prevent you from utilizing DeFi lending to its fullest. DeFi lending methods actually allow liquidity providers to share in the pool's trading fees in accordance with their holdings. The increased benefits may be able to lessen the effects of temporary losses. DeFi lending risks of temporary loss can also be reduced by using liquidity pools with stable asset classes. Impermanent loss should be considered a reasonable risk rather than a roadblock to the DeFi space. Number 2. DeFi rug pools. One of the prominent responses to the question, what are the risks of DeFi lending, is provided by DeFi rug, which has recently been a major highlight in the DeFi industry. Even while DeFi seems fairly promising, the ecosystem's rules are not entirely apparent. Investors must therefore have faith in the platforms before they are willing to lend their funds or buy tokens from them. Investors, however, may become victims of rug pull operations which violate such trust. A new kind of exit scam is decentralized finance, is what DeFi rug pulls call conning DeFi lending threats. Developer of DeFi built a new token and pair it with other cryptocurrencies like ETH to establish liquidity pools and similar frauds. The new coin would then be advertised by the developers, who would then nudge users to add it to the pool. The DeFi creators employ backdoors after amassing a substantial sum of the most popular cryptocurrency, ETH, in the pool. Millions of additional coins are created thanks to backdoors that were purposefully incorporated into the token's smart contract. The only thing that would be left after selling the new coins for ETH would be the worthless tokens. After that, the developers would vanish into thin air. In 2020, one of the well-known instances of rug pull concerns in DeFi loans attracted attention. The creator of SushiSwap, Chef Nami, sold his sushi tokens after amassing more than $1 billion in collateral. The incident reduced the value of Uniswap's rival token to nearly nothing. It is without a doubt one of the most spectacular incidents in DeFi history, raising awareness of the risks. DeFi rug pulls and exit scams make up nearly 99% of all blockchain-related fraud operations in this $1 billion market. Number 1. Flash loan attacks. In the DeFi industry, flash loans are a brand new kind of uncollateralized loan. In the world of traditional banking, there are two different loan types: unsecured loans and secured loans. Unsecured loans typically have lower loan amounts and don't need any collateral. Secured loans, on the other hand, are larger and require particular security such as investments, real estate, vehicles, or other assets. Throughout the entire loan process, banks can assess a customer's reliability by using resources like credit scores and reports. Flash loans, a particular type of unsecured loan based on smart contracts, are a key entry in DeFi lending hazards. Smart contracts are used in flash loans to eliminate all the dangers connected to unsecured loans in conventional banking. However, one particular aspect of flash loans demonstrates how special they are. The entire amount of a flash loan must be repaid by the borrower in one transaction. The lender can simply reverse the transaction if the borrower does not repay the debt. However, because they could be used for market manipulation by bad actors, flash loans might pose a serious risk in DeFi lending. Additionally, some agents might use flash loans to pursue personal objectives by taking advantage of the weak DeFi lending protocols. There is no surprise that the expansion of decentralized financing will increase the danger of DeFi loans. Due to the volatility of crypto assets and malicious DeFi developers rug pulling, you have experienced an impermanent loss. Additionally, you can see how cutting-edge DeFi solutions like flash loans are being reclassified as dangers. Understanding the three main dangers associated with DeFi lending gives one a clear idea of the potential future course of DeFi. Additionally, identifying the dangers associated with DeFi lending would help to advance current procedures. The content in this video is for entertainment purposes only, and hence should not be considered financial advice. Do conduct your own due diligence and consult your financial advisor before making any investment decisions. With that, we have come to an end. See you in the next one.